Hello and welcome back to our final demo video for the week. In this video, we're going to go through problem 8-10B, which will help with your homework problem, problem P8-10A. So I'm on page 419, and we have to do journal entries for accounts and notes receivable. Super easy, right? So what do we have here? Well, we have Dalmas Incorporated. They began operations on January 1st, and they have several transactions for the year. So we see on May 2nd, they received a $28,800 60-day 10% note on account from Hawkins Company. So on May 2nd, May 2, I'm going to make the recording. I have a notes receivable for Hawkins. So 10-day, 60-day, 10% note on account from Hawkins Company. So it looks like what had happened was Hawkins Company originally had an accounts receivable with us. And instead of writing it off, we talked with them and they said, hey, we don't want this to impact our credit negatively. So how about a notes receivable? Would you be willing to accept a notes receivable, give us some extra time to pay you back? We said sure. So we're going to debit notes receivable for Haskins Company in the amount of $28,800. We're going to credit accounts receivable Haskins for the same amount, $28,800. So basically what happened was somebody owed us money. Haskins specifically owed us money. They had a 30-day accounts receivable. It kept going past the due date, and we talked with them, and we says, look, you owe us money. We're going to write you off and not accept any credit, not offer you any credit anymore. They didn't want that. They wanted to pay us. They recognized they were having some issues. We decided to work with them, so we offered them a note. Okay? So this is a 60-day 10% note in payment of account. Okay? So on July 1st, we received payment from Haskins for the note plus interest. So they made good, and we need to book our entry. So they are within their 20 days, right? 60 days. What are we receiving? We're getting cash. They're paying us, right? What else are we earning here? Well, we charge them interest. So guess what? We have interest income. So I need to credit interest income for the amount of the interest that they owe us. And I also need to recognize that they don't owe us that notes payable anymore. Or notes receivable anymore. So I got to get the notes receivable off the books. Okay, for how much? Well, it's on the book for $28,800. That's the principal amount. We're getting that back. They owe us interest income. Well, how much? Well, let's think about this. We were charging them $28,000, the principal amount was $28,800 times my interest of 10% times 60 out of 30, right? 60 out of 360. So when we're calculating interest, instead of taking out of 365, we're going to use 360 days for the year. So we earned or made interest income of $480. What's the cash amount we're getting? Well, we're getting our principal back, $28,800, plus the interest income, $29,800. What are we doing here? Well, we're recording collection of principal and interest. Okay, so we have another July 1st transaction. We received a note from our Longo company. It's a 120-day note. It's 9%, and the amount is $61,000. So what we're going to do is we're going to say, okay, on 7/1, we have a notes receivable. This time it's from Longo, and it's $61,000. Okay. The amount was $61,000, but it was on account, right? So same thing happened, right? Instead of them accounts receivable, maybe the accounts receivable went too long, we turned it into a note. We can do that if we want. We have $61,000 for AR for Longo. Remember, always indent your credits. And what are we doing here? Well, we're saying recording recording note receivable, and it's 120 days at 9%. Okay. So what happens next? Well, on October 29th, our Longo failed to pay their note. Okay. So they didn't pay us, right? How much do they owe us? Well, they owe us $61,000 plus the interest income that we earned from this note. So what are we going to do with it, right? Well, they still owe us a note. They still owe us money. We're going to turn it into a receivable, okay? So on 10/29, we're going to say we now have an accounts receivable for Longo. This time it's $61,000, the principal amount of the note, plus, do it this way, plus 61,000 plus the interest income that they owed us, which is $1,830. So they owe us $62,830 now, right? We earned income. Just because they didn't pay us doesn't mean we didn't earn income. We have interest income we need to book. It's a income account, right? Or it's a revenue account, interest revenue. So it's just like sales revenue or rent revenue. It increases with the credit. So how much? Well, that's easy to calculate, right? I already did it, but 61,000 times 0.09 times 120 over 360. And how much are we going to get the notes receivable off the books for? Well, what we put it on for. We put it on for 61,000. We need to get it off for the same $61,000. Our debits and credits equal in this transaction. We're good. So what do we say here? Well, we're recording the dishonored note. Okay. So let's see what else happens. Well, on December 9th, we wrote off our Longo account as uncollectible. Dalmas Incorporated uses the allowance method for providing for credit losses. Okay, perfect. So we need to get it off of our books and recognize that we need to debit something. We're not going to debit accounts receivable. We're going to debit that contra contra asset account, allowance for doubtful accounts. So I'm going to debit allowance for doubtful accounts. Come on. Bear with me here, sorry. That was 12.9. Put it in the wrong spot. 12.9. Allowance for doubtful account for 62,830. Why? Because that's what it was on the books for. I'm going to credit accounts receivable Longo for the same 62,830. Oops. Okay. So what are we doing here? Well, we're saying we wrote off Longo account. Okay. So what happened next in December? Well, on December 31st, guess what? We received a $42,000 90-day 9% note from R Canal on account. Okay. So we're going to do the same exact thing basically. 12.11. What do we have? Notes receivable for who? Canal. For how much? Well, they tell us that it's for $42,000. We need to credit AR for Canal for the same amount, $42,000. Well, what is this? Well, it's a note. It's a 90-day 9% note. Okay, on December 31st, we need to record expected credit losses for the year by an adjusting entry. Accounts written off during the first year have created a debit balance in the allowance for doubtful accounts of $61,000. An analysis of the aging of receivables indicate that the desirable balance of the allowance account should be $12,500. So let's think about this. We need to, first of all, let's do our journal entry, right? We know we need to debit bad debt expense. Okay. We know we need to credit allowance for doubtful accounts. Okay. Pretty simple, right? We need to figure out how much that needs to be. So they tell us that that we originally had a debit balance of $61,000. We need to get that $12,500 higher. So we're going to take our beginning balance, $61,000. We're going to add to that the $12,500 that we figured out based on the aging. That equals $73,500. So what we need to do is get that allowance for doubtful accounts up to that $73,500, right? Allowance for doubtful accounts should always have a credit balance. They tell us it has a debit balance of $61,000. Okay? So in order to get this to $12,500, we need a journal entry of $73,500. Think about it this way. Allowance, right? That's our allowance for doubtful accounts T account. We know it has to have a credit balance, right? Well, right now we're in the hole $61,000. Our balance should be $12,500, right? we're already in a hole. So in order to get it to 12.5, we're going to take our 61,000 credit balance that we're in the hole. We're going to add the 12.5 that we need. We get 73,500. So that's the amount of the journal entry. The allowance for doubtful account balance is right here. It's at 12.5. So I'm just going to plug in those numbers. And we are good to go. Okay. So the last thing they tell us to do, we need an explanation here. And we are recording, so we're doing this to record allowance for uncollectible accounts. Okay? And then the last thing we need to do is we need to make an appropriate adjusting entry for interest. Yeah, that makes sense. That makes plenty sense. Because think about it. We're on 12/31, right? Canal owes us money. We have a note, right? It's a 90-day 9% note. We need to do an adjusting entry, right? Think back to chapter 3 or 4. I can't remember off the top of my head. We need to do that accrued revenue entry. Okay, not a problem. I can do that. I need to recognize that I have interest receivable, and I've earned interest revenue or interest income, whatever we want to call it. Doesn't matter. How much? Well, that's easy, right? They owed me originally $42,000. That's the principal amount times the interest. Well, what's the interest? It's 9% times 0.09 times time. Well, how much time do we have here? Well, we only have 20 days, right? They took it out. We got the note on December 11th. It's now December 31st. That's 20 days worth of interest. So I'm going to multiply that by 20 over 360. I get $210. 210. What am I doing here? Accruing interest revenue. Okay, and there you go, my friends. That is problem 8-10B. Should serve as a good template, so to speak, or logic on how to do your homework problem 10-A. But if you have issues, just reach out to me. Be happy to work with you and work through some of your questions. So thanks. Have a great week, and I'll be talking to you soon.